You need to see a green light on your microphone. That's it. That's working. And Shetty, is yours working? Okay. Great. So my name is Crespo. I'm chief editor at Nordic Fintech magazine. And today in our amazing panel, we have Andrei. Please introduce yourself.
Hi, I'm Andrei Kirilenko. I'm a professor of finance at the Judge Business School of the University of Cambridge.
And Shetty.
Hi, everyone. I'm Siddharth Shetty, the co-creator of Finternet and currently driving Finternet Labs.
Okay, so just get it. So the first name is?
Siddharth.
Siddharth. Okay, sorry, I was addressing you fire. Okay, Siddharth. All right, that's great. So future of money is one of the most interesting subjects out there. I'm very, very pleased that we have a mix here of backgrounds so that hopefully we can have an interesting discussion. Let's start with the painfully obvious. What is money?
Do you want to?
Yes, so I started thinking about it recently. So what is money? And the way I just sort of think about it is in the following way. You can roll it back quite far. And I started rolling it back and rolling back. And it turns out I went all the way into people who study human brains. And what they've discovered, it's research that they've discovered, is that humans are fundamentally different from any other animal, according to them, in one unique feature. Humans are the ones who are able to imagine the future. Because money is useless if you cannot think of the future. Like to a lion, there is no money for animals because they can't imagine what the future is. Money is something that transfers value from the past to the present, from the present to the future, in whatever form, right? For a long time, we had money that was separated into a token. It could be a shell, it could be paper, it could be metal, it could be something that is, digital representation of what's in your bank account, and logic. So the logic would be, say, in the payment system or in the banking system. Let's say you have the tokens, but you can't use the logic. It's useless. Yeah, you can just look at it and enjoy it, or you can. Now, for the very first time, we're actually moving into money that is pure logic. Right. There is no token anymore. Mm-hmm. Yeah, and that's what makes it very, very interesting, because money has now reached the new form. It's transferring value, but as pure logic, not as a passing of tokens.
Right. Siddharth, anything to add to that?
Yeah, I think over and above that, the way I think about it is it's core to human coordination, right? Both money in its traditional sense, like cash, but also monetary instruments, if you generalize that, like futures, derivatives, and other types of monetary products we create. But all of it comes back to a form of enabling human coordination between humans and resources. And I think the fundamental shift that's happening is you've gone from either that money being represented through physical objects like shells to then tokens like cash or cash instruments, equity shares, property documents, where we had essentially physical tokens. And those were self-contained, self-describing tokens. So you give me that cash, it's mine. You give it to me at 2 in the night, it's mine as well, right? There's no concept that the computer is asleep. But over the last few decades, we digitized those representations of value, right? So that money now sat in some ledger where the logic of verifying it sat somewhere else, the logic for validating it sat somewhere else. And now for that same transaction where you could hand me €1, your bank and my bank had to integrate. And so that severely limited transactability. Because you were dependent on not just your intention, but did your bank or financial institution support those transactions?
Because they own the logic, not you.
Exactly. Mm-hmm. And so I think now if we see the fundamental shift that's happening through tokenization or more digital native representations of money, although it seems abstract, it's fundamentally giving you that verifiability and that transactability back in your control. So I think really to boil it down, it's a form of human coordination, and now with greater transactability means we can coordinate a lot better.
All right, so thanks for that. I think it was important to understand really what is it that money is being used for, because that the digital representation of money that we're going to be talking about today conserves those same qualities. Now, I think for anyone that's maybe not directly into the world of digital money, we're hearing tons of different terms like tokens, central bank digital currencies, stable coins, and all of these promise benefits: immediacy, transparency, speed. Have we seen any real world value of any of these new modalities of money in the actual real world, or is it just theoretical at the moment? What's your take on this?
Yeah, so maybe I could give a shot.
Go for it.
And you could go ahead. Is one, I think back to the initial part of what you outlined is traditionally you'll unbundle money into its three core forms: a unit of account, store of value, and medium of exchange, right? Now, a store of value is questionable, especially in countries that face high inflation. And so then you're already looking at different other types of assets to store it, not just traditional money. A unit of account, yes, it makes sense because it lowers transaction cost. Imagine denominating, my flight ticket in shells and, my hotel room in something else. It's really expensive. So I think that continues to retain value. Otherwise, the transaction cost of coordinating because of differential exchange rates would be very high. And medium of exchange so far was really restricted because of how we digitized these financial systems. Because my ability to transact with you, if you think of, let's say, I wanted to send you a US dollar, how did I do that? I either gave you a physical green dollar, but that was constrained by the laws of physics, which means, if we were in two different countries, it's really hard for me to send it to you. I would have to send it to you through like carrier pigeons or post or whatever, right? And obviously a $10 note, I can't tear it up into $1. So one was I could transfer it to you physically. The second is we digitized, and that's how you had the correspondent banking system come up, right? So that dollar got represented on the Fed's ledger. Access to the Fed's ledger would be given to, say, a commercial bank like JP Morgan. And then you created a set of bilateral partnerships. Finally, if you had access to that account, who had access to the ledger, you would be able to transact the dollar. But that was severely constraining. And in fact, the global phenomena of de-risking means that a lot of individuals were being shut out of access because of just the high costs of compliance. And now you look at stable coins, anyone with an internet connection has access to the US dollar, right? And that's a huge flip. So you've gone from, physically, I was dependent on physical proximity to get access to the dollar. Then I was dependent on the correspondent banking system. But when you look at stable coins, anyone with an internet connection gets access to the US dollar. So I think what we're seeing is an evolution. I mean, back to your point, on at least the terms you mentioned, CBDCs are traditionally thought of as representations of central bank money, both to entities in a wholesale manner or to individuals in a retail manner. Stable coins are really representations of private money. And so you could have two forms of representations of private money, either that is created by banks, like tokenized forms of their deposits, or that's created by stablecoin issuers, where they essentially create a wrapper on higher grade treasuries. So these are either representations of public money or private money, and you can use it as you deem fit.
Right. Okay. I think that's really interesting. I would love to touch back on that for a moment. But Andrei, just going back to you talked about the temporal factor of money, and we have an interesting question on the board. It says, can money then be defined as memory? Maybe this is more of a philosophical question, but I'd like to give you a chance to maybe comment on that.
Very much so. So we'll need to define what that is. So let me unbundle it some more, and then I'll also comment a little bit on what Siddharth said. So when I said that for a long time, money was split into token and logic, that's how I keep thinking about money now. Because these things about store of value, medium of exchange, all of that, that is token focused. And we're moving away from tokens. What does that mean? What is Bitcoin? So Bitcoin, according to the white paper, is not a coin. It's a chain of digital signatures. Chain of digital signatures is logic. There is no token anymore, right? This is important. If there is no token anymore, because tokens are dumb. They do not hold any memory. You cannot write anything into them. They cannot compute anything. Logic is smart. You can embed a lot of things into logic because logic is what it is. You can embed memory into logic. Chain of digital signatures is memory. It remembers what the previous signature was. Otherwise, it does not get executed, right? So, and that remembers what the previous one was, and that remembers what the previous one was, right? Whereas with the token, pure token, it remembers nothing. You know, you pass someone a note, it doesn't remember anything whatsoever, right? You cannot embed memory into that. Memory is embedded in the logic owned by someone else. Banks would have the logic. They will remember what happened to your account, not you. Right. So now, when we're moving to money, which is pure logic, that means if you can control the logic, you control your money. Not someone else, not someone who is in charge of it. So think of it this way. Also, and not even a nation state. So Russian central bank thought that it had all of these reserves. Well, it has the tokens, but it can't use them because the reserves are frozen. You look at them, they're still yours. You don't control the logic. Yeah, so you can enjoy looking at it, but it's not yours. That's all that is, right? And in fact, it's used against you, if you will, you know, from their perspective. So yes, that's exactly right. The logic embeds memory in the form of blockchain as a chain, right? There are other ways to embed memory.
Right. I love the direction this discussion is taking because it's very conceptual, but of course we need to understand the concept before we can actually define the instantiation of it. Now, we talked about private and public forms of money, and we're talking about control. The ones that control the memory are the ones that...
Public is the one controlled by a public entity. Logic is controlled by a public entity. CBDC is the liability of a central bank. They are liable for it.
Right.
Stable coin, the logic is controlled by a private entity, not you.
Yes.
Stable coin issuers, right? So, but it's a private entity now, not a public entity.
All right, so this is probably an interesting discussion because I don't know if you were here in the previous panel, but we had Christian talking about how the Bank of International Settlements is been pushing CBDCs for quite some time, basically because saying this is the one that we can control. Who should have control, or who should have the monopoly on money?
Do you remember how this CBDC thing started? So the BIS for a long time was saying, oh yeah, you know, crypto is just fake, you know, nothing. Then Libra comes out. Facebook comes out with Libra. Within 24 hours, managing director comes out and says, we need to do something. Because Libra has 2 billion users around the world. And it has a messenger app inside of it. What prevents you from sending money through Facebook Messenger? You can send a smiley face, you can send a token, right? And they're like, shit, 2 billion users. A lot of central banks are going to become obsolete, so they started pushing this idea. I think it's a dead-end idea. They spend a lot of resources. They build Fintech centers around the world. I don't think it's a good idea at all. I'm scared of it. I don't think it should be done.
Right. And what's your take on that, Siddharth?
On CBDCs or
on who should control who should be the monopoly, the monopoly of money? Which hands should it be placed upon?
Yeah, so I think the question of monopoly of money is really a political question. You know, it's nothing to do with technology or operate. Obviously, technology can change political dynamics, but really it's a broader political question on who controls that monopoly, who controls power, and what those equations look like in the world today or going forward. I think that's one part to it. That being said, however, when you look at infrastructure like CBDCs, for example, there's also a huge operating element that comes in, right? Which is, for example, let's say you are a central bank. You're used to working with a limited set of entities. How do you now work with, for example, you know, 1 billion users or 10 million users or 100 million users? So over and above the question that you asked, there's also the operational element of how do you actually work with users and customer support and all SLAs and so on.
Can you even do it?
Which institutions may or may not be designed to do. Now, this may vary depending on state and market capacity gaps in different jurisdictions. But fundamentally, there's also that element which comes in, which is, do you have the capacity and ability to operate infrastructure, which is also why the two-tier banking system got created, because otherwise the central bank could do all credit intermediation, but then I have to sit and underwrite everything from someone's car loan to a home loan to other kinds of activities, and operationally that's not feasible. What's also interesting, I think, if you look at developments, and I'd be keen to get Andrei's perspective, is there are broadly two camps, right? So one, if you look at it from a Bitcoin perspective, but if you look at more recent crypto developments like stablecoins, they still go back to be denominated in the US dollar, right? So they're enabling greater transactability because it's a more programmable form of the dollar that you can use on internet rails. But at the end of the day, it still goes back to the US dollar or equivalents in whichever currency. So I think it might be interesting, I think from a Bitcoin perspective, what that looks like. And does that also become a unit of account going forward? I don't know. These are questions that I don't have answers to. But
I have some answers.
Yeah.
So if you actually looked at the dollar bill and actually read what's written on it, one of the things you're gonna read in there, one is it says "In God We Trust," but there's some other language on it, and the language says, "This is legal tender for all debts, public and private debts." It doesn't say anything about payments, doesn't say about anything exchange, doesn't say about any store of value, any other bullshit. Debts. This is a note that gives you zero interest. It's a zero interest debt note. That's how it was created in the beginning during the US Civil War. It was a 0% denominated debt. It's a debt note. So a stable coin is similar in that way. And that's why it's mostly US based, because US has a lot of debt. You can actually put something on the asset side and issue a digital representation of it. Europe does not have a lot of debt. It's why are European stable coins are not coming about. What are you going to put on the asset side? There is not that much, European the EU the EU money, the euro, was not created as a form of debt to pay for war. It was created as an instrument to integrate very disparate countries. So there is austerity, less debt, making sure that, fiscal is not broken. There's very little debt. Germany is going to start issuing debt now, probably for like the first time ever since Second World War, to pay for defense. Maybe we'll now have a euro coin, right? So stable coins now are mostly dollar denominated because there's stuff to put on the asset side. Once there is stuff to put on the asset side in other countries, we will see, China again doesn't like to issue debt. Why are we not seeing Chinese stable coins? We may see euro coins. We may see other coins. I think to me it's an issue. It's just like what can you put in there?
All right, I would like to perhaps take the discussion to the philosophical realm, because for me, when we look at money controlled by central banks and we look at Bitcoin, I think it's clear to everyone that's looked into this that we're talking about a different of ideologies. We have open, anonymous, transparent versus closed, private.
Yeah, think of it, who controls the logic?
Right. So
Bitcoin, you control the logic. It's your digital signature.
Yeah.
Central bank, it's them.
It's the central banks. Now, my question to you is, with the advent of Bitcoin and other Ethereum and other crypto coins, can they coexist in a future where we see both camps which are opposing ideologies taking up as much sort of a followership or as a support from the public?
The way I see it, I have friends and colleagues, and I've placed PhD students, and some of my co-authors work with central banks. They're cool, but I can tell you this: every central banker I know wakes up in the morning and thinks, "I hope this Bitcoin thing disappears," because it's an existential question. It questions your existence, because if you can have that, what am I for? Yeah, so they not only coexist, I think logic, money as logic is going to drive money as tokens out eventually. It's token money is too old. It's too obsolete. It's not needed. It's clunky. It could be used for, previous panel people talked about corruption. You can build corruption around tokens. Much more difficult to build corruption about logic because logic remembers. Is it clean chain of digital signatures or is it not clean chain of digital signatures? It remembers. This stuff, it doesn't remember. You can launder it. Tokens could be laundered. Chains, much, much more difficult to launder. Right? I think it will drive it out.
Interesting. Any points, Stan?
Yeah, so I think there are two parts to it, which is there's the element of human behavior and there's the technology itself, right? So I think if you look at why were public authorities created, and obviously the extent of public authority intervention varies in different markets, but parts of it were essentially to govern aspects of human behavior, right? What happens when things go wrong? What happens when there's a crisis? What happens when you have large amounts of fraud? And you see that even in crypto today, right? So for example, when fraud takes place, you can't resolve that using smart contracts. You end up going to the court system, right? And that's just because the complexity, embedding the complexity of human behavior into code is just computationally too expensive to do, right? You can't govern any possible interaction through a set of smart contracts and write all of that down, right? It just makes the system extremely clunky, slow, difficult to scale, which is some of the challenges we see today. So the way I look at it is it's important to look at a model of coexistence between public authorities and private sector, especially if you're looking at adoption in the here and now, right? So yes, these will change over the next few decades, but when you're looking at adoption this year, next year, and how do you use technology that's coming up to genuinely improve the lives of people on the ground, I think it's important to take a more pragmatic ideology where you look at coexistence between both. And what that allows you to do is then also say, okay, what are the better safeguards? So for example, public chains do allow you better forms of observability, because in the financial system today, you don't observe truth, you observe copies of the truth because it's a lot of paperwork and fraud gets buried in that paperwork. So how do you use the new infrastructure that's coming up to actually strengthen a lot of what's being done? How do you use the new infrastructure that's coming up to do things that you couldn't do before? For example, today you have 100 countries that have a population less than 10 million. The way you traditionally build financial infrastructure is in a very purpose-specific manner, right? And that's very expensive for a large part of the world, because now you're building a payment system from scratch. Then you have to build capital market infrastructure. Then you have to build open finance rails from scratch. And we've tried that. And I've been involved in numerous efforts where that takes 5 years, 10 years. It's not going to happen. So I think, how do we look at the question of coexistence to bridge? And that bridge drives accelerated adoption. And it also reduces the complexity of otherwise bringing all of those burdens onto the underlying technology, is an area that I think is also worth exploring.
Right. Okay.
I did not say that central banks will disappear. I said central bank tokenized money will be driven out.
CBDCs?
Well, CBDCs could exist in the form of pure logic. They don't necessarily have to involve a token. Mm-hmm. So, for example, central banks also issue reserve money. Mm-hmm. Reserve money is critically important. This is financial institutions' money. There are finality of settlement. They only exist in a digital logical form. They don't exist in any other form. So that kind of money that is, you have a dumb token and then you have someone building a logic, which is very expensive in a lot of jurisdiction, as you said, building the whole stack of logic from scratch, but by someone else. I think the money that is token plus logic, central bank version, will disappear, but the central bank money, which is logic because of the contract incompleteness, in order to achieve finality of settlement, you may need, in some circumstances, central bank logic only money, because that is only money that is trusted enough by others for the finality of settlement.
Right. Okay. So then let's try to bring this down to the application, to the practical application of new modalities of money. In your view, what needs to happen for new modalities like CBDCs, like stable coins, like Bitcoin, to really be taken up as, I will avoid saying payment mechanisms, but let's call them debt off-charge mechanisms, because we don't see that yet, right? They just only store value somewhere. What needs to happen for them to become legal tender, to use the terms that you referred to earlier, Andrei?
So I was a regulator for a period of time, and I can tell you that, you know, for a regulator, pushing an innovation has no upside but has a lot of downside. So regulators typically react to something bad happening. Financial crisis, something breaking down, flash crash, something. It's something that you have to fix. Because if you're a regulator and you come out and they say, let's do this, and it backfires, what's the upside? You gain nothing. If you're a company, you gain from the upside. Regulator, no. So they'll be reactive. This is normal. This is how they build. This is fine, right? So how this is going to evolve is it is in the form that something bad is going to happen, and that something bad is going to trigger that adoption of that innovation. Okay. Yeah. So let's say something bad could be high inflation. Something bad could be a massive cyber attack. Something bad could be war in Ukraine. A lot of people are using stable coins in Ukraine because there are capital controls. You cannot take your money out of Ukraine. Now, the central bank, the National Bank of Ukraine, by law, has to impose capital controls during the wartime. They're not bad people. They have to do it. It's the law of the land, right? So, but millions of people moved to other countries, including here. There are lots of Ukrainian flags around here. Families came here. They need to pay for medicine. They need to pay for food. They need to pay for stuff. Their money is in Ukraine. How do you take your money? Stable coins. Bad thing happens. Large adoption of technology follows from that. And then people are like, you know what? This looks good. This looks fine. This works. I don't need to ask anyone for permission. And that's how I think that's sort of what I think is how things have typically done. Just like the US dollar was created as a result of a civil war, the bloodiest war in the history of the United States. It didn't come out because people are like, oh, let's do it.
Yeah. Okay. Thank you, Andrei. We have 30 seconds left. Siddharth, any last thoughts on adoption?
Yeah, so I think consumer adoption really comes down to trust, right? And the way I look at it is, I don't know what the future is going to look like, and that's based on various variables, political power and other equations playing out. And so therefore the question is, how do you give yourself the optionality today? How do you design architectures that give you the optionality today so that depending on how the future is playing out, you can plug in or plug out? And so therefore, when it comes to things like stable coins, there are also fundamental problems that have to be solved for on the merchant acceptance side. How do you bridge with economies that have efficient fast payment systems already? How do you solve for confidentiality? Because all transactions in stable coins today are public, and I don't want all my money transactions to be public. So I think there are a set of technical aspects that have to be solved for. There are a set of bilateral interoperability aspects that have to be solved for. And then it's about how do you create that trusted brand as well, where today stablecoins were primarily used for crypto trade settlements. For that to shift to forms of merchant acceptance, you need to build a trusted brand, much like Visa, MasterCard have done, where if you're a card holder, you're really abstracted away from the FX processes. You're not thinking about a lot of that underlying complexity. Yeah. So I think there's those areas of maturity that need to fall in place for stable coins or other forms of tokenized payments to scale out.
All right. Well, unfortunately, we've run out of time. So please, let's give the panel a great big hand of applause. And thank you so much.